Have you ever seen a huge company suddenly change course and wondered, how did that happen? Well, a lot of the time, it's because one person, one single investor forced their hand. Today, we're going to pull back the curtain on that whole world, and we're going to do it by looking at its most legendary and, most controversial figure, Carl Icahn. I mean, think about that. For decades, that's what people have said about this guy. He's not just some investor buying stocks. No. He's been called a corporate raider, a champion for shareholders, a force of nature who's built a massive fortune by basically showing up and shaking corporations to their very foundations. So how does one guy get a reputation like that? What does he actually do? And really, this is the whole game right here. He's an activist investor. This isn't your Warren Buffett style, buy a great company and then just wait. Nope. Icahn's whole strategy is to find a good company that he thinks is being run badly, buy a massive chunk of it, and use that ownership to get a seat at the table and demand things change right now.
And look, this isn't just random. The guy has a playbook. It's a formula he has run over and over again, and it's all designed to find and unlock value that he believes the people in charge are just completely missing. Okay, so let's break this down. Step 1 is pretty standard investing, right? Find a company with good stuff, strong assets, but a cheap stock price. But step 2, that's where the magic happens. He buys so much of the company that the board can't ignore him. Think about the pressure. Suddenly, you're not answering to some faceless group of shareholders. You're answering to Carl Icahn. And that directly leads to step 3, where he forces them to make huge moves, sell off a division, spin off a part of the company, or buy back stock, all to get that share price to pop. So, to really see this playbook in action, you got to look at one of the most epic, most public battles in Wall Street history, the war over Herbalife. And believe me, this was not just about business. It got personal, fast. So, here's the setup. In one corner, you've got this other billionaire hedge fund manager, Bill Ackman. He goes on this huge public crusade, says Herbalife is a total pyramid scheme, and he puts a $1 billion bet on its stock going to zero, a massive short. But then, in the other corner, you have Icahn. He sees Ackman's attack and thinks, opportunity. He decides Herbalife is a solid business being unfairly attacked, so he takes the other side of the trade and goes long, big time. And I'm not kidding when I say this got public. This wasn't some quiet backroom deal. These two guys went on live television and just tore into each other. It was a total slugfest. Insults flying, shouting, an absolute legendary moment. And the whole financial world was glued to their screens, just waiting to see who would crack first. And when the dust finally settled, the winner took home an absolutely mind-boggling amount of money. Yup, $1 billion. That was roughly Icahn's profit when he finally cashed out years later. It's the perfect example of his strategy, right? He found value where someone else saw nothing but trash. He had the guts to hold on through a massive public fight, and he walked away with a fortune, leaving Ackman with a crushing loss. Now, a key part of this story, one of the main things Icahn and activists like him push for, is for companies to buy back their own stock. It's one of their favorite tools in the toolbox. So if we want to understand the playbook, we have to understand the weapon. Okay, the share buyback. It's one of the most common things a company can do with its cash, and also one of the most debated. For an activist investor, though, it's often demand number 1. The idea is actually really simple. A company has a pile of extra cash, it goes out into the stock market and just buys its own stock, and then those shares are basically retired. So think of it like a pizza. The pizza doesn't get any bigger, but if you remove a few of the slices, the ones that are left are now bigger. That's a buyback. So why do guys like Icahn love these so much? Well, for starters, it instantly makes the company look more profitable on paper. It juices a number called earnings per share, or EPS. Let's say a company earns $100 and has 100 shares. The EPS is $1. But if they buy back half those shares, they still earn $100, but now the EPS is $2. It doubles, just like that. Plus, it's often more tax-friendly for investors than getting a dividend, and it sends a huge signal for management that they think their own stock is the best investment out there. But, and this is a big but, it's not that simple. The whole idea of buybacks is at the heart of this huge debate. Is it a smart financial move, or is it a red flag that a company is basically giving up on the future? So here's the two sides. The bullish case, the people who love them, say, look, if the stock is undervalued, buying it back is the best possible return on investment for the owners, who are the shareholders. Simple. But the bearish case, the critics, They say it's just a short-term trick. It's financial engineering. They'd argue that money should be going into R&D, new factories, buying other companies, things that create actual long-term growth and jobs. A buyback, they say, is a sign that a company has just plain run out of good ideas. All right, so we've looked at the man, his playbook, and his favorite weapon. So what's the big takeaway from all of this? How can you or I actually apply some of this thinking? Well, you don't need billions of dollars to start thinking like Icahn. First, be a contrarian. Don't just look for a cheap stock. Dig deeper and find that hidden value the market is missing. Second, don't just find value. Look for a catalyst. What could happen that would unlock that value? And finally, and this is the most important one, think like an owner, not a renter of a stock. When you own a stock, you own a piece of the business. Thinking that way forces you to ask the tough questions and demand more from the companies you invest in. And that really is the final thought I want to leave you with. When you look out at the market today, which companies just seem stuck? Maybe they're mismanaged or they're just sitting on a pile of untapped potential. Which businesses are out there right now just waiting for their own Carl Icahn to come knocking?